Hey everyone, welcome to another Fifth Person Roundtable discussion. I'm the editor-in-chief of the Fifth Person. My name is Adam, and with me today I have Rusmin,
Hello everyone.
Victor,
Hi everyone.
both of them are the co-founders of the Fifth Person, and our lead analyst with us today, Kenny, once again.
Hello.
So welcome everyone to the show, and today we're going to talk about Singapore banks and the fact that they recently cut their dividends and what does that mean for investors, right? So just a few weeks ago, MAS, the Monetary Authority of Singapore, released a statement saying that they wanted the local banks, namely UOB, OCBC and DBS, to cut their dividends to within 60% of what they paid the previous year. So when they announced that, the stock prices of the three banks basically came down 3 to 5%. Some investors didn't like the news, but we wanted to discuss that topic today. So what does it mean for investors? Do you guys have any idea what this could mean for the banks in general, and in light of the COVID-19 situation and all that?
I think basically the MAS is being very, very conservative. They try to, firstly they stopped the bank from doing their share buyback, and now they ask the banks to cut their dividends 60% of the previous year. I think they want the banks to be well prepared if the COVID situation were to drag in a prolonged period. So I think that's always been the character of the MAS. If you look at the Basel III standards, right, it's about 4.5% for the CET1 ratio. And if you look at the other regions like Malaysia, Thailand, and Indonesia, right, they are also following the Basel III 4.5% minimum requirement. But whereas if you look at Singapore MAS, right, the requirement is 6.5%. So it's basically MAS add another 2% on top of it. So to us, I think that the MAS is being very, very conservative, and I think it's a good thing for the banks, because if you look at the three banks in Singapore, right, they are generally actually quite strong in terms of their financial capital.
All right, so maybe just for a very quick background of what the Basel III ratios and all that, in case those people who are watching it don't really understand, could you briefly explain what the CET1 ratio is, and just very briefly?
Okay.
Yeah.
So basically the CET1 ratio, which is the Common Equity Tier 1 ratio, right, it actually measures the core capital over the risk-weighted asset. Okay, so the core capital is basically your equity, your retained earnings. Your risk-weighted asset is basically the loans, the interest-bearing assets that the banks are lending out to earn the interest. If the loans, right, they lend out, right, they lend out for interest, but there's no collateral, right, then this weightage for this loan, right, will be very high weightage.
Okay.
Whereas when they loan it out to, or maybe they went to buy government bonds, right, and government bonds, the weightage will be very low and almost zero, because they view it as safe. So when the risk weighted, right, usually is weighted over the very risky assets.
So you're saying like some loans are just naturally more risky than other kinds of loans. So like mortgage loans are generally safer than business loans, for example.
Yeah, depends on whether they got collateral or no collateral.
All right. So you were saying that the CET1 ratio, the Basel III requirement was 4.5%.
Yes, correct.
But in the MAS in Singapore, they raise it to 6.5.
6.5%. So if you look at the tier 1 for Basel was 6%, but MAS put it as 8%, another additional 2%. If you go to the total capital, it's actually 8% for Basel, but for MAS it's 10%. So basically, every ratios that the minimum requirement for Basel, when they set, right, MAS will add a 2% to it.
All right, so there's a CET1 ratio and there's a tier 1 ratio, different things. So basically the point is the MAS is more conservative and they want to make sure that the banks in Singapore are as solid as they can be. So let's just stick with the CET1 ratio, and it's 6.5% in Singapore. So what is the CET1 ratio right now for the three banks?
Okay, so if you look at the OCBC, right, the CET1 ratio is about 14.2%, followed by UOB at 14%, and the DBS at 13.7%. Yeah.
All right. So that is more than double what the MAS actually wants to have. So that's
why I'm saying that the MAS is being very, very conservative.
So
I don't know about Singapore, but in the US, if you don't meet the requirements or you're like 1 or 2% off, the regulators will limit the executive compensation. They will limit the share buybacks, as well as they will limit the dividends that they may pay out. So banks generally try to have a huge buffer on top of the benchmarks. That's for the US banks.
Yeah. Okay, so I remember saying that I think recently the Fed also recommended that US banks also conserve their cash, and the banks have to go through a stress test. If they can pass that stress test, then they're allowed to give dividends to a certain amount. So it's the same thing that's happening all over the world, not just in Singapore, where central banks basically are saying that, guys, we need to conserve cash. because we don't know how COVID-19 how long it's gonna drag out, and how bad it's gonna be. So I mean, some figures, I think the GDP for Q2 in Singapore, I think was negative 12.6% year on year compared to the previous quarter. So we can see the effects of COVID-19. Unemployment rate is 2.9%, which is the highest since I think 2008 during the financial crisis. So you don't know how long how bad this is going to be. So what do you think? Do you think is the MAS being too conservative, seeing that the CET1 ratios are among the highest in the world for Singapore banks? Do you think it's a good move?
I think generally MAS did a good move. I think it's better to be more conservative than be more aggressive. Okay, so because nobody can predict how the situation is going to prolong and whether this COVID-19 will cause a lot of people to default on the loan. So I think it's a right move to being conservative at the right time. But the next thing I want to talk about is don't worry about the dividend cut, because if you look at the track record of the Singapore banks, right, usually on the bad times, right, they'll tend to cut their dividend. But after the bad times are over, right, their dividends are always on the increasing trend.
So right? I mean, yeah, because I was going to ask you that, because when the MAS announced this recommendation, the share prices of the three banks in Singapore just basically dropped 3 to 5%. So basically, some investors weren't happy about that, right?
Yeah.
So, where's my dividend going to come from now? And it's a 60%. It's 60%. It's quite a cut. So I mean, what would you say to those investors? They're not happy about this. Where's my dividend going to come from? What would you tell them?
My take is you should look on the long-term perspective. If the COVID-19 situation were to recover, I think banks will be one of the first few companies to rebound very fast.
Okay, and I think so Rusmin.
Yeah, I think it's really a good move because Singapore government has been very conservative. I think since the independence, right, from Malaysia, banking in Singapore is really heavily regulated, and they always say that there's this saying that what is not expressly permitted is forbidden in Singapore, right? Basically, anything that is not being said by MAS that you can do, you simply cannot do.
If you don't give you the U-turn sign, you cannot U-turn.
You cannot U-turn sign, right? So I think this has been for almost 3 decades after the independence, and ever since in 1997, I think MAS has since started to relax the rules. I think they actually started to open up to a lot more banks to actually compete here in Singapore. But this has been the key essence on the reason why Singapore has been very successful, that actually gone through a lot of crises in the past, like the crisis in the 1987. For being conservative, that allows Singapore to actually go through this kind of crisis. And if you look at the Asian financial crisis, Singapore banks, 4 of the big banks, I mean, it used to be 4 big banks, now we actually only have 3 big banks. The reason is because UOB actually bought out the OUB in the past, in 2002. Right? But during the Asian financial crisis, there isn't any banks is actually being hurt because of the Asian financial crisis, right? And then after that we have SARS, and then subsequently the big one will be the global financial crisis. And yeah, so being conservative is really very important, and it will allows the economy to basically go through this crisis like COVID-19, because no one really know how long this is going to take actually.
Yeah, I mean, the Asian financial crisis was a major one in the region, because I remember that was a really tough period, and I remember Thailand, and I think it was South Korea as well, right? Indonesia, was it terrible there?
Yeah, it was terrible.
I remember it was really bad, but we were one of the first to get out of that crisis, if I remember correctly. And this is all due to the financial strength we have, and not just in the economy, but within our banks as well. So I think one of the risks of a bank going something goes wrong with the bank is the bank run, right? Yeah. People are afraid that the bank's not going to survive, and they deposit their money there, and if they don't know the bank's going to survive, they're going to do a bank run. They're going to go and withdraw all their money just in case. Yeah. And if that happens, that's going to be a major thing. So, what do you think? Is that ever going to happen in Singapore? You think?
Actually, I don't think that's ever going to happen in Singapore, because I mean, the people trust the government to be the risk manager of the banks, and they're very conservative because I think they of course took they saw what happened in the US back in 2018. They don't want to be the one that has to step in with the taxpayers' money to
in 2008, right?
To bail them out, and then that's a waste of taxpayers' money. But I rather than cutting dividends and everything, because this is quite different from a financial crisis, is that during a financial crisis it's a slowdown. So people do travel, people still go out and eat. It's just a slowdown. But during the coronavirus period, the pandemic period, it's a total shutdown of industry, like the travel industry, and all these planes, right? If they don't reach a certain load factor, let's say more than 66% of the plane capacity to be filled, right? It's really an unprofitable flight. And then of course you have the pubs in Singapore where they cannot really gather, or clubs and restaurants, they are suffering. So there's more likely that they will go bankrupt. And then what the government is trying to do is, with the help of the banks, they are trying to give them assistance. So they will guarantee 80-90% of the loans. They are working with the banks, right? 80-90% of the loans. Then 10% to 15% the banks will bear the risk of default in Singapore. So I think it's a good move, because the thing is, if the virus were to be over next year, you want as many businesses to be open as possible, so that there will be a bounce back. Right, then people can be re-employed and go back in the workforce and start making money again. But however, if you would let all these small medium businesses go bankrupt, it will be much difficult time or longer time for Singapore to recover in a year's time.
I don't think there will be ever a bank run in Singapore unless
Touch wood, right?
government system in Singapore become corrupt and people started to lose trust. I think this is a trust that has been built since day one, and that's the reason why I think Singapore becomes a financial hub. And it's something that I don't think government will let it happen, that someone else or external forces to erode the trust that they have built in Singapore. I think this is the primary success why Singapore is really successful today, because of the trust that they have built. Okay, so as long as the trust is maintained, there won't be any bank run. In fact, I'm not going to the ATM to withdraw more money out simply because of the COVID-19.
In fact, I mean, maybe Victor, you can tell us, maybe pull out this stat, is that, you know, we deposit money with the banks in Singapore, right? So during moments of crisis, do people withdraw money from the banks here, or do they put in more money because they think that the banks are safe havens? You know, what is it like?
I mean, of course, if you look at the past crises of, let's say, companies like UOB, during the 08-09, during the bad times like SARS and all this, somehow there's a drop in the total deposit.
Okay.
There's a slight drop.
Okay.
Just a slight drop. Okay. Less than 10% drop. Okay. But then if you look on the longer term, right, eventually, right, the deposit actually still go up on the uptrend. Until now, it's still going up, even though now we are in the COVID situation. The latest first half, they talk about the deposit actually went up for all the three banks. So not much of a concern, I would say.
Okay, so even during COVID, the banks are actually taking in more money.
Yeah.
People are depositing more money.
So probably during crisis, the deposit drop. I suspect probably they take some of the money and went to buy shares. Is it?
I mean, I don't know. Maybe is the government giving out the money to everyone, and it just goes straight to the bank account? Maybe it's that. I don't know. Yeah. So I think one.
No, but I'm talking about the drop is during the SARS period.
Oh, that was in SARS.
Okay. But the 08-09 was actually there's no drop. It was just going up, but it's just slower only.
Oh, okay. But so SARS was in 2003.
Yeah.
All right.
But
so
overall, every year they're always increasing their deposit. Right?
Okay. Yeah. So I think that's the strength of the local banks that we have, and they are the backbone of the Singapore economy. I think without the banks, you know, you need finance in the economy to move things around for the economic system to work.
I think without a good government, the bank would be shaky. So credit really goes to the government that actually has built the kind of system that is so robust.
So so we can tell that Rusmi is very pro Singapore.
So are you going to be Singapore citizen?
So you know, whoever is watching this, you know what to do, huh? Okay. Anyway, let's move on. I think one of the major trends recently in the last few years is the planned introduction of digital banks, right? We're hearing, you know, maybe like companies like Razer, they want to go for the digital license, basically to be a digital bank. So I think we need to maybe highlight that. Is there a threat to the traditional banks? You know, if there are more digital banks coming up, what's it going to mean, you know, 5-10 years down the road? Is there a threat to, you know, the business model of traditional banks, and would investors be actually worried about that?
Well, I don't think it will be much of a threat, because I think even if they were to establish as a digital bank, they have about 3 to 5 years, 5 years of run rate. Because when they get the license, they have a cap of about 50 million in total deposits that they can raise, and these deposits they have to be raised from their existing customers as well as shareholders and staffs, and basically there's a limit, and then per account they only can raise a maximum of $75,000 of deposit, because the MAS want to see all these digital banks see that they are able to comply, they are able to manage risk, and at the same time, when they apply for these licenses, they have to make sure that they submit an exit plan.
So there's like a proper due diligence that's happening is to make sure that you can't just get a license for a digital bank and then and be done with it. You have to prove it over the next few years that you are reliable, reputable, to basically show them that you're doing you know what you're doing, right?
Yes, that's right. And also at the same time, when you get the license, you have no access to retail depositors because
okay.
the government want to protect them and then show that you're able to manage risk well. And then you need to have a paid up in capital of 15 million to start, and then to graduate to become a fully licensed digital bank, you need to have 1.5 billion in paid up capital,
So
which is a lot.
stages to that.
Yes.
All right.
Yes.
So how many digital bank licenses is the Singapore giving out?
So right now they have two digital bank license, full digital bank license that they are giving out, and they can basically do everything. And then aside from that, the only thing is that they have no access to the ATMs at all. So everything is fully digital, and then there'll be 3 wholesale banking license. Yeah, so a wholesale banking license basically cater to all those unmet needs. So actually, generally, the main idea here for all these digital banks licenses is because the government want these banks to fulfill all the unmet needs. So for example, like all the startups, micro enterprises, maybe the foreigners that are in Singapore, as well as millennials. So they are banks that do not, these are companies that do not have much track record when starting up. And usually the big banks like UOB, DBS, as well as OCBC, they might not want to take on the risk. So digital banks basically have the advantage because they have a lower efficiency ratio or cost to income ratio. That's what they call it in Singapore. Efficiency ratio is what they call it in the US. Efficiency rate, cost to income ratio is basically by taking the operating expense and you divide it by the total income, basically the net interest margin plus other incomes that the bank generate, right? So and it gives them a lot of advantage. For example, in the US, Exos Financial is a digital bank, so their cost to income ratio is about 33%. And then other banks like JP Morgan, Bank of America, Citibank, as well as Wells Fargo, the big banks are around 67%.
It's double.
Yeah, it's almost double.
Yeah.
So in a way, they have cost advantage. So because the digital banks basically are, just for your information, digital banks are simply means you can do all your banking online, right? So
no branches, no ATM.
Any physical branches? I know there are no ATMs, right? But physical branches.
No physical branches.
No
They-
physical
no
branches.
physical
They can have one headquarters.
yeah.
Yeah.
Okay.
So everything can be done through your phone or your computer, right? Whether it's opening of account, applying for credit cards, applying for loans, everything is done online through your phone. So and it can be expedited, and at the same time, in the long run, it might lower the risk because they think that because everything is done digitally, they are able to use data and AI to determine how much they charge for.
I mean, they should have that in the traditional banks as well, right?
I mean, the traditional banks are doing it right now already.
Yeah, they have
Because
the
they're
analytics and all that. But I think the main advantage would be the cost efficiency, where it's like half. I mean, there's a lot more efficient to run a digital bank. But of course, there are drawbacks. You don't have physical branches. You can't see someone over the counter to help you with stuff. But
you can't draw money to go hawker center.
I mean, I need to eat my char kway teow or something, or my chicken rice, and then you need cash to. But that's changing as well, right? I mean, now hawkers nowadays are also accepting digital payments. So I mean, you're saying, Kenny, like Axios is in the US, right? So in that market, the digital banks are already there.
Yes,
right.
But the thing is, it's harder to compete in terms of the deposits, right? Because people usually have trust in the big banks and they have access to ATMs. And then the way they compete is basically they offer a higher deposit rate. Higher deposit
interest
rate,
rate.
than the traditional banks. And at the same time, there's no minimum, so you don't have to have a minimum of $1,000 in the bank. And if you fall below, they will not charge you a fee. Yeah, so there are a lot of other things. At the same time, maybe they are also able to offer, because they have to charge a higher interest for all those loans. Basically, all these startups in Singapore.
They're higher risk, right?
They're taking on higher risk. So that's basically their role in Singapore. The government want them to take on this risk to serve the unmet.
So there's a gap in the market where there are smaller businesses that need smaller loans, maybe they don't qualify for the big banks. So these digital banks play a role in serving this part of the economy to drive economic growth and all that.
Yeah.
So it's more like expanding pies with, of course, more players in the market. It's not just like the same pie with more players, right? But now we are looking at the bigger pies that serving the unmet needs on those client with higher risk. So those were probably the area where I think digital bank players will be able to catch on. In fact, I think since 2014, I think China also has digital bank players over there. So it's nothing new actually. It's just quite new in Singapore because Singapore MAS just going to give out this digital banking license. But in China, I think currently there are already 4 digital bank players that have already got licensed. Some of them as early as since 2014, and one of them is actually WeBank, which is owned by WeChat,
Yeah.
which is owned by
Tencent. Yeah.
right? So their main focus is also mainly digital, right? I mean, they've got close to 900 over millions of users on the WeChat.
Yeah.
Actually, WeChat is an app that you can't live in
Without-
China without
yeah,
it.
yeah. It's a
So
super app.
they have a lot of users. I think they have close to today, as of 2019, they have 200 over million of customers, right? So they already have pretty much growing very fast on the year-to-year basis. And again, their target audience for when it comes to lending out the money is microloans, which is what Kenny has shared. Basically, they are reaching out to those people that tends to be higher risk. They don't really have a steady income, or they don't have any collateral to pledge, or SME that are in the rural area, they don't really have access to the traditional credit system that is provided by the full bank, the traditional bank. Yeah. So it could be an expanding pie that we are looking at now. Also, the same thing happening in Singapore. Yeah.
And also the reason why they cannot attract such a large deposit because the older folks are the ones with the money, but then they are more unlikely to use these digital banks because they are not used to it and they have to be acquainted with the technology and the app. So it's kind of difficult for them. So that's the reason why they are not able to. I don't think they are able to attract as much deposit as we thought it will be. And also going through the documents and reading the news, it seems like the MAS will ensure that the competition is controlled, so they don't take unnecessary risks like raising as much interest on the deposit as possible to attract as much deposit as they can, or take on too much risk just for the sake of growing their loan books. So that won't be happening, at least from the documents that I read, the MAS documents. Yeah.
Okay, I think that's a really good point because I think the number one product that the bank is selling is actually trust, right? Because you're going to put your money with somebody, you take care of my money, put it in the bank. You have to trust the bank.
Yeah.
So that's what the traditional banks offer. They've been around for decades. You can trust them.
Yeah.
You know, I mean, 2008 financial crisis set aside. But generally, you want to trust where you're going to put your money. So I think it's a really good point that you brought up there, where you know, the older people, they're used to the traditional banks. If you have like $2, $3, $5 million, you're going to put it somewhere. You're going to put it with a bank that you trust, right? Not a digital bank, because you're talking about a lot of money for some of these people. So I think for us here, you know, the 4 of us, we're kind of like in between. We're not too old, we're not too young. So I mean, we grew up with traditional banks. So I think I'm going to pose this question to all of you. If you had, let's say, maybe $1 million to put away in a bank, you know, just as a bank account, would you dare put it with? Would you put it with traditional bank, or would you put it with digital bank? For you guys,
For now, definitely.
Now it's traditional bank.
traditional bank still.
Majority will be traditional banks, but digital banks will be probably like temporary. You know, I always think digital banks are almost like you know, in WeChat they have the wallet or Grab wallet. It's just where you just temporarily put like maybe a couple $100, maybe a couple $1,000, and most just for maybe you got certain advantages because they work with certain vendors. Then you get discounts, right? Then you like to have that option. But if not, I will not definitely put all those in. But at the same time, you need to remember that in Singapore they do guarantee the deposit. I think one of the smartest thing that in the US they did during the 2008 financial crisis is they guarantee the deposits, and then that kind of gives the confidence. I think that's also partially why we are confident in the banks in Singapore, because they guarantee a certain amount and people probably open multiple accounts and But
I think the digital banks, like we always been saying, that the threat for the digital banks in short to mid-term is generally, I think, quite low. Because I think a lot of the Singaporeans or the investor in Singapore, they are worried about the digital banks is because I think they still have the image of the local telcos where the fourth telco came in and all the competition came in and you can see all the telco share price drop. But the problem is, right, banks and telcos are different. Okay, because when the new telcos came in, they fight by price, people just switch the telco. Okay, but when the new banks come in, right, you don't withdraw out all your money from one bank and go to another bank, right? Right, there's still like you said, it's a trust business, so we don't really withdraw everything and put into the new bank because we scared that maybe the new bank cannot survive, you know.
You think people will go for like the highest interest rate? Oh, this new bank is like giving me an extra 0.5%. I'm going to put my money there. No,
you're still definitely going to allocate some small sum first. Yeah.
I think probably we will still go to the digital bank. Just that there's like Kenny said, there's a small amount of money will be in the digital bank. So your main big bulk of the deposit is still on the traditional banks, and adding new banks to the industry to the industry, right, is not new to MAS. MAS have been adding a lot of new banking license, right, since 20 years ago until now. So if you talk about full bank license, right, in Singapore there's about 24 full bank license.
Oh wow, okay,
24.
24.
Four of them is actually the local bank, 20 of them is the foreign bank. The only difference between the foreign bank and local bank full bank license is that the foreign banks, like, they got limitation on the ATM. Okay. But then you are just adding another 2% into the 24 players, you know, that is already in the market. Okay, and if you talk about a wholesale bank, it's even more competition because the MAS have been keep consistently adding new wholesale banks license for the past 20 years. So the wholesale bank license in Singapore is about 96 of them.
Wow, okay.
Right? So you're just adding another 3 to the 96. So the competition is not new. It's always been there. There's always competition, but in the end, the first mover advantage of the 4 local banks, right, the Singapore, your DBS, your POSB, which is under one, your UOB, and your OCBC are already entrenched as a first mover advantage in Singapore already. So it's very hard to compete with the first mover player in Singapore. So like I said, in short to mid term, right, I think that the threat is low. But in longer term, right, we don't know whether the consumer, the newer Malaysian player, right, the millennials,
the Zoomers,
or the Zoomers, right, they will go to just going purely on the digital bank. So that is one thing that we cannot see on the longer term. But short and mid term, I think there's generally is still okay for the traditional banks.
Well, as an end user, I'm happy that there are more players in the market because that will kind of like force the local banks to innovate, come out with the better products. I mean, as an end user, we will benefit, right? If someone can give me a loan that is better rate than the local banks, I will definitely would consider, right? I mean, this is what the digital bank players that probably will try to target that niche segment, right? They want to probably will offer a higher interest rate to those millennials, right? I mean, although Fox probably won't even be aware of these things, right? Because they don't really use so much on digital tokens and all that stuff, right? And yeah, so this is an area I think it'll be quite interesting. I mean, once they come out, I will probably be interested to look at their product. I mean, I'm more tech savvy, so I will also look at what kind of interest they offer, how much the amount that they guarantee. So I'll probably put some money there because it's guaranteed by the government. So at least if anything happened to them, the risk will be very low. But of course, a bulk of my money at the end of the day will still be parked at the traditional bank.
I think people are worried because of the digital banks is they scared the profits of the local banks will drop and eventually they cut their dividends.
Yeah. That's the main question.
Yeah,
right?
correct. But if you were to look at OCBC, Singapore is only 49.7% of their total operating profits before allowance. Okay. Their total operating profits, Singapore only accounts 49.7%. So that means 50.3% is overseas. Then if you look at UOB, right, for 51.8% is local Singapore and 48.2% is overseas. And if you talk about the biggest banks like DBS in Singapore, right, they have about 66.3% of their operating profits before allowance in Singapore and 33.7% overseas. So generally, I think our local banks here, they are not only in Singapore, but they are also outside Singapore. Their deposits they take are not only in Singapore, but also outside Singapore. Their loans are also outside of Singapore. So generally, Singapore, I think is just a very small market for them. Right? It's of course a big portion of their operating income, but then they still got other markets. So we don't need to worry whether their profits will be affected and eventually they cut their dividends. I think eventually it will still balance out in the other countries that they can loan out more, and after that they balance out the profits and all this.
So I mean, Singapore banks are not actually Singapore banks. They're actually very regional banks. Nowadays, really, they're one of the best in Asia as well. So I think so I guess the main question is whether their profits will be affected. So like you're saying, Victor, 3 to 5 years you don't see any threat because most people will still stick with the traditional banks. It's going to take some time, but then moving on, we don't really know because maybe like our kids will be banking with, I don't know, Razer. We don't know. So that's different, right? I think we're going to wrap this up. I think the main question right now is, a lot of people watching this will be, so would you invest in the banks, right? So we're not giving any recommendations or anything during this this presentation or anything, but we are all shareholders of the banks ourselves,
Yep.
correct? So I own all three banks. I don't know about you guys. What do you guys have?
I own 2 banks.
You own 2 banks.
Me too.
only. So I'm the one that's with all 3. Rusmin has OCBC. So we are all shareholders of the local banks,
Yep.
all right? So we're
So
shareholders.
let's hope for the best.
Hope for the best.
Yep.
So as a shareholder, and knowing that dividends have been cut,
Yep.
was it? I think Victor, you can tell us. Recently, first half OCBC was the dividend was 60% of the previous year.
60%.
60%
plus a bit only. 62
Okay.
or 60.
So they did follow the recommendation
yes,
by the MAS.
the DBS also 60%.
Okay,
UOB was about 70%.
Yeah, 70%.
Yeah.
So how come they're at 70% and they didn't go to 60%?
I think UOB generally they tend to give out more, but because they also have a special dividend. So
Okay.
I'm thinking that they won't be giving the special dividends.
Okay.
So if the special dividend were to take out, probably they're going to be 60%.
So it's still like gonna be
Yeah.
60%. So you
Yeah.
can generally assume that the banks are going to follow the MAS recommendation
Yeah.
to limit
Yeah.
FY 2020 dividends to be 60% of the previous year. So I mean, some investors, like I said, didn't like that. They sold the shares.
Yeah.
The price came down. Now is kind of like rebounded to where it was
Yeah.
before the announcement. And we're shareholders ourselves. So what would you do right now? As a shareholder, what would you do? Or maybe someone who's not a shareholder, they're looking to consider the banks.
Yeah.
What would you do with the banks?
I think the bank is generally quite attractive now, but if you look at the trailing yield on the dividends, the UOB is about 4.67%,
Okay.
DBS about 5.42%, and OCBC is about 4.92%. But before the cut, they are around 6% plus.
Yeah.
So actually, buying a local bank at 6% plus is a very good dividend income stock,
Mm-mm.
right? So if you can see on a longer term perspective, 3 years, 5 years, that COVID is no longer there,
Mhm.
okay? So if I were to value, I will value based on the dividend before it cuts. So
Okay.
that means my potential, when the thing recover, I will get back the 6%.
Mm-hmm.
Okay, but now while holding, I still got 4+%, close to 5,
Mhm.
right? But when it recover, I got my 6% yield.
Mm.
Okay, when I got my 6% yield, right, on top of that, the banks always have a track record of consistently increase their dividends,
Mhm.
right? So if you hold the banks over a long term, right, your yield on cost will generally keep increasing on.
Yeah, but I think no one really know what's going to happen
Yeah.
to COVID or how
Okay.
early the economy going to recover.
Right.
So it's always very important to also diversify
Yes, correct.
Yeah.
the portfolio. I mean, this bank is just a small part of our portfolio,
Yeah.
Mm-mm.
right?
Yeah.
And it's very important to take into account of diversification.
Yeah, correct.
Yeah. So I like what Victor says. It's true. I mean, like you're basically getting an underlying dividend of 6%. I mean, it's very hard. I mean, for REITs you get like 6%. I mean, it's very rare for banks to get 5-6%, and because it's on a down cycle, interest rates cut to close to 0. So this is a good way to take advantage of the situation. And but at the same time, like let's talk about the virus a little bit about the virus, right? They say the vaccine that's coming out in the next half of the year is probably have about 60 to 70% effectiveness. So but the benchmark is around 98%, right? Then
Okay.
that's where the vaccine is, right? So
Which vaccine is this? The Russian one or is this the American one? Or I don't know which vaccine is this one.
generally the medical experts like on the news say, right, basically all the vaccines that are coming out right now is
Okay,
around
okay.
60 to 75%
Okay,
around the
okay,
range. Yeah.
okay.
So but then after that, Bill Gates came out to say that to get that 98% benchmark probably conservatively by the end of next year. So if that's the truth, I bet things will get worse before it becomes better. So the thing is not to focus too much on the near-term pricing, and of course you also don't want to put everything into the banks
Yeah.
right at once, right?
Yeah.
If there are better opportunities, then you can average down a little bit. So that's basically what I'm doing. Yeah.
So basically, what we're saying is that pre-announcement, the dividend yield for the banks was about 6%.
Yep.
Yeah, but because we know the MAS wants to make sure that the banks are remain conservative, conserve some cash, we're going to see a forward yield of about 4%. I think if it's going to cut 60% fully, because trailing, Victor was saying trailing was about 4 point something percent, right?
Yeah.
So if you're going to put in the second half of 2020 and 60%. I think the forward yield is going to be about 3%, high 3% to 4%. So you're not going to get 6% yield.
Yep.
But in the meantime, assuming that COVID is taken care of, the vaccine is like they announce it. I mean, once the vaccine is out, things change completely, right? Yeah, everything just changes completely. But I mean, that's far off. We don't know yet.
Yeah.
But it could be 6% once this recovers. And in the meantime, you're getting 3-4% to wait, right? And we all know that the Singapore banks are generally really, really solid when it comes to their CET1 ratios and all that. So, as a shareholder with yourself, what would you do with the banks? Like, Victor, Rusmin, Kenny, what would you do?
I mean, if I don't own the bank now, I think it's very attractive right now.
Okay.
We'll just hold and wait for the economies to recover and dividend will start to increase. By then, price will hopefully will start to increase, right? And I think the property is high because Singapore government actually, again, they have been actively stepping into the market to assist a lot of businesses, jobs, right? Make sure that people are not defaulting on their loans, because if the whole loans, a lot of people default on their loans, the whole domino effect will just take place, right? So, so that's why it is very important to have banks that are backed by a strong government. I mean, government is essentially the sponsor of the banks, if you look at it.
In some way,
So if you have faith in Singapore economy over the mid-term to long-term, then again, the chances are very high that the bank should continue to do well over the long run.
Okay.
Yeah, I think it's a pretty attractive investment. Like Adam said, you get paid 3-4% to wait, and then after in a couple years you double your dividends, and then you get capital appreciation. I generally invest mainly in the US market for capital appreciation, but it's just because it's too attractive for me to forego. So I actually invested in the banks in Singapore, and like they all say, the government is basically the best risk manager when it comes to the banks. The banks will not fail, and now they're putting in a lot of these measures to ensure that they pull through. So the worst that you can expect is basically it takes a longer time to recover, and then your returns might be slightly lower. And that's it.
So those are our general views. I for myself, I would just hold on to my stake, and I wouldn't buy more. I would just hold on and wait. I think the banks in general are going to remain solid, but I don't know when COVID is going to recover. I'll just wait in the meantime. So once again, no recommendation or whatever. Just make your own decisions when it comes to your own investment portfolio and what makes most sense to you. So I think that was a really good roundtable discussion, guys. I really, really enjoyed it. So thank you once again, Victor, Rusmin, Kenny.
Yeah, thank you.
All right. Thank you for being here, and thank you for watching this. And we'll see you around again.
See you.